economists seem divided on the health of the U.S. economy.
I would say this is the most confusing moment in U.S. economic history.
I'm not seeing any kind of recession signs.
There's a recession in our future.
A top concern for Americans: will they lose their job?
We have twice the number of job openings as we have workers searching for work. We've never seen that.
So, it's hard to see how we could be in a recession with that level of job growth and income growth.
At the same time, big companies are already announcing layoffs, including Best Buy, Ford Motor, HBO Max, Peloton, Shopify, Walmart, and Wayfair. Now, a survey shows 50% of firms expect to reduce their labor force in the next 6 to 12 months.
There are going to be more layoffs, so you need to be, wary of that.
Is the U.S. economy on the brink of a major recession, or are we already in one? And are massive layoffs on the horizon? The discrepancy over whether there's a recession depends on if you focus on gross domestic product data or what's happening in the labor market.
A recession is about what we produce as a country, how much income we have as a country, how many jobs are out there. Right? This is big picture, and a recession means we're going backwards.
Well, recession is defined as a broad-based, persistent decline in economic activity, and the arbiter of recessions is the Business Cycle Dating Committee, which is a group of academic economists that are at the National Bureau of Economic Research, and they look at a plethora of economic data. GDP is one of the indicators, and that by itself would be signaling, yes, a recession has occurred in the first half of this year. Look, we did not suffer a recession in the first half of this year. Yeah, GDP declined 2 quarters in a row, but that's a rule of thumb. That's just a rule of thumb.
The GDP measure is kind of like a scan in medicine. It can tell you've got a lump, but not what that lump is. And you actually need to look at far more detailed information to know whether it's benign or whether it's, actually something serious.
The U.S. is only in a recession if it is officially declared by the National Bureau of Economic Research, and they've not done that yet.
There has been a lot of talk recently. We're in a recession. We have 2 quarters of declining GDP. That often happens with a recession. There's a reason people talk about that. But we have job growth that is incredibly strong. We have an unemployment rate that is a 50-year low. In some ways, I'm like, I'll take it.
Very, very strong still in the labor market. We're still printing new payroll job numbers at a high level.
The single most important thing is, well, do I have a job? Do my kids have a job? Does my wife have a job? Those are the kinds of things that people, I think, look at.
Fed officials closely monitor job openings to check on the health of hiring. In July, there were over 11 million job openings. That shows there's a shortage of workers for available positions.
If it does turn out that we are in a world of a persistent labor shortage over time, that'll be a challenging world for companies.
So it's a very interesting time in the economy when you have restaurants and hotels and airlines still starved for talent and trying to hire as quickly as possible.
In July 2022, the unemployment rate was at 3.5%, a low that matched pre-pandemic levels.
We've been rescuing the job market from the pandemic downturn and stabilizing the economy after its unprecedented disruptions. We brought the United States back to full employment in record time.
Then unemployment ticked up 0.2 percentage point in August. That means thousands of people are entering the workforce.
We did see a welcome increase in labor force participation. Nonetheless, still a full percentage point below where it was before the crisis. And I think it's important as a society that we have measures in place to support a strong labor market and high labor force participation. And that goes beyond what we can accomplish with monetary policy.
And then you have other parts of the economy, like tech and e-commerce and real estate, that experienced explosive growth during the pandemic and that are perhaps kind of tilting back to normal now, that perhaps expanded too quickly, that grew too fast, and that now need to tighten, rein in their belts a little bit. That said, we're seeing all of these headlines about recessions and about layoffs.
The layoff rate has stayed under 1% of the workforce. That's 1.4 million people as of July. That's close to historic lows.
And that's because in restaurants and in hospitals, it's kind of almost impossible to get fired right now. There are such shortages of talent that companies are kind of prepared to give workers a second chance.
The Federal Reserve is raising interest rates at this point in an effort to slow down the job market, and that's going to mean more layoffs.
Layoffs are already hitting the tech sector, like Klarna, Snap, even Best Buy and Walmart. Now companies like Google are hinting at potential cuts, as more and more CEOs expect a recession. But economists say the top 4 most recession-proof industries are healthcare, government, education, and computer and information tech. At the same time, the labor market is facing off against the Great Resignation.
They're not quitting to walk away from work. They're quitting to get a better job.
In July, 6.4 million people got new jobs, while another 4.2 million people quit jobs.
So there's very rapid turnover, very rapid churn. That means there's also a lot more hiring taking place. And yes, it is a little bit of a cycle, but it's not just circular. People are trading up. People are getting big wage increases from switching jobs. Job switchers are seeing much bigger wage increases than job stayers.
The first time in a long time, workers are getting a bit of the upper hand, particularly lower wage workers. That's actually where we've seen the big wage increases.
The broad set of data suggests that, we're moving forward. The economy's still expanding. It's not in recession, but it's a struggle.
The most immediate challenge, of course, is to return to an environment of stable prices without sacrificing the economic gains of the past 2 years.
For now, it doesn't look as though we are in a recession yet. Many people are betting that we will be in a recession by the end of the year, however.
It's hard to say what indicators are best to watch right now.
At the top of the list is consumer confidence and the change in. The best indicator of future recessions, if businesses and consumers lose faith that's going to happen, they'll pull back and we go into an economic downturn recession. So sentiment, confidence, particularly the Conference Board survey of consumer confidence, is a very, very good leading indicator.
The longer that inflation remains well above target, the greater the concern that the public will start to just naturally incorporate higher inflation into its economic decision making. And our job is to make sure that doesn't happen.
So I think it's very important to look at the number of job openings. I think the question is how steeply they will fall, how sharply they will fall. If they go back to 7 million, the level before the pandemic.
If the unemployment rate rises more than 4 or 5/10 percentage point in a 3-month period, in all likelihood, you're going in, because that means that businesses are laying off workers, and you get into that. That's going to cause sentiment to collapse, and you go into recession.
ZipRecruiter's job seeker confidence survey in August showed 1 in 4 employed job seekers feel less secure about their current job than they did 6 months ago. That's an all-time low.
Companies trying to slow down their hiring a little bit. There are always people hiring, even in a recession. There are companies that need to get things done.
A recent PwC survey found 52% of companies now have hiring freezes, while 44% are rescinding job offers, and 46% are getting rid of new hire signing bonuses. And roughly 50% of the companies surveyed are reducing their overall headcount.
I expect layoffs to rise. The Federal Reserve is raising interest rates at this point in an effort to slow down the job market, and that's going to mean more layoffs. And so we will see layoffs pick up going forward.